Well, I tell you, Sarah, we still do favor technology. Now, a lot of this, we think there's going to be good earnings growth in technology. It's not as cyclical for the most part. The parts of it that we like are things that deal with automation and efficiency. So we continue to be overweight technology here. We don't think interest rates are going to go much higher, let's say, for instance, a 10-year yield than where we are right now. And we think this is an adjustment period. Obviously, there's been some churn here and technology has been hit, but we expect it as we move through the year to regain some footing here and do better, certainly in the second half of the year, if not sooner than that.
So I think you have to feel that inflation has peaked and that we've sort of priced in max hawkishness from the Fed to have that view, right?
Yeah, and I think, Sarah, right now, if you think about what's been worrying the market lately, I mean, this China and the supply chain and slowing growth and, what that's going to do to inflation, which, the Fed could make a mistake here. Those are the kind of concerns that's really taken the air out of the market lately. I would argue the market was hanging in pretty well until this China shutdown situation, lockdown situation, really started to accelerate because earnings are coming in overall slightly better than expected. Slow growth in earnings, but that's what the market expected. So, maybe you're up toward 7-8% growth in the first quarter. That's a couple of percent better than expected. So I don't think it's earnings. I think it's the bigger concepts: supply chain, inflation lasting longer, Fed making a mistake. Those kinds of things that are really creating some headwinds for the market here.
Just want to zero in on the action right now into the close. It's getting worse, down 3.7% on the NASDAQ composite right now. The S&P is now down over 2.5%. And there is the Dow Jones Industrial Average losing 700 and almost 40 points into the close here. Scott, just be specific. So what parts of tech would you buy here? And does any of it have to do with valuation at this point as we head into heavy earnings? Today, we're going to get Alphabet and Microsoft. Tomorrow, Meta, and then Amazon and Apple.
Yeah, Sarah, you need to focus on the companies that own their niche, that are growing their revenues. And as I said, if they are involved in increasing automation for companies, if they're involved in increasing efficiencies for these companies, those are the ones that we want to focus on. Now, that could be an equipment company. It could be a software company. It just depends. It's a company by company type of basis. But I think our message to our clients is that, yes, interest rates are higher here. They've made a big move. But if you look back at the last 6 or 7 hiking cycles, on average, what sector has done the best through those hiking cycles? Technology. So I don't think it's a right to count technology out here. Obviously, taking it on the chin here
but they had such
recently,
a strong
but we think it's going to be better. They did.
I mean, we just talked to Barry Knapp. He said there's so much more to go. It's hard to make even a valuation case at these levels when you've got an economy that is slowing and interest rates that are rising. Even if you see a peak, there still could be more downside.
There still could be. And, Sarah, if you look at it, calendar year 19, 20, 21, the S&P 500 was up more than 92%. Technology did better than that. So, there has to be some give back here at some point. And is this the beginning, or do we still have a lot more downside? We don't think we do. And this is where we want people to, we want them to be putting their toe in the water here incrementally if they have cash on the sidelines that they want to dedicate to stocks.